Hello everyone, I'm Alex. Ever wondered how dividends actually work and why some investors receive regular payments simply for owning shares? Consider this scenario. Investors receiving $200, $300, or even $400 every quarter without any additional labor. No side hustle, no management oversight, and no need to monitor market fluctuations at midnight. This is capital being deposited into an account, stemming from equity ownership in some of the world's most established companies. That is the reality of dividend investing. Today, we will analyze the dividend process step by step, defining what they are, understanding the distribution mechanics, strategies for growth, identifying common risks, and how you can begin constructing your own portfolio. Let's begin. First, the core question: how do dividends work? Companies earn profits. Fast-growing startups pour every dollar back into expansion. But mature, stable companies, the ones making products you use every day, generate more cash than they need for growth. After paying employees, bills, and reinvesting a bit, they share the extra with their owners. If you own their stock, you are an owner. That shared cash is the dividend. Classic examples include Coca-Cola, Johnson & Johnson, and Procter & Gamble, brands that have been paying American shareholders for decades. Let's see how it actually pays out with a concrete example. You invest $5,000 in a reliable company. The share price is $50, meaning you purchase 100 shares. The company pays $2.50 per share annually, which is approximately 62 cents every quarter. Every year, you receive $250 straight to your brokerage account. That is a 5% yield on your $5,000, and you get paid just for owning the stock. Think of it like this. Imagine putting $5,000 down on a small rental property. The tenant pays rent every month. The property might even appreciate in value. Dividends are exactly the same. They are rent checks from owning slices of real businesses. No tenants to chase, no repairs, just ownership rewards. Now for the real power. Most companies and almost every U.S. brokerage allow you to automatically reinvest those dividends to purchase more shares. It is called a DRIP, a Dividend Reinvestment Plan. Instead of taking the $250 in cash, it buys you more shares. Now you own slightly more than 100 shares. Next year, a slightly bigger dividend, and the snowball keeps rolling. Start with a modest $250 a year at the top of the hill. Let it roll for 20 to 30 years with average market returns, and that snowball can grow into serious passive income. This is how patient investors turn small investments into meaningful streams of money that arrives whether they work or not. Taxes on dividends? They're actually favorable if you hold long term. In the US, if you own the shares for more than 60 days, qualified dividends are taxed at the long-term capital gains rate. Depending on your income bracket, this is usually 0, 15, or 20%. Compare that to ordinary income tax rates, which can be as high as 37%. It is basically a tax incentive to be a patient investor. If you are trading in and out quickly, you often pay those higher ordinary rates. The winning strategy is simple: buy quality companies and hold them forever. Many investors do this in tax-advantaged accounts, like Roth IRAs or 401ks, to minimize or even eliminate taxes altogether. Important warning: never chase sky-high yields. A stock advertising a 12% yield looks tempting, but usually the share price has already collapsed. The company is struggling and offering a big payout to lure buyers, even though they cannot afford it long term.
It's like a failing shop putting up massive sales signs right before closing. Healthy, sustainable yields from strong U.S. companies are typically 2 to 5%. Always look at the payout ratio, the percentage of earnings they're actually distributing. Think of it like a personal budget. If a company earns $100 and pays out $50, they have $50 left for emergencies and growth. That's healthy. But if they earn $100 and pay out $110, they're dipping into savings or taking on debt just to keep shareholders happy. That's a house of cards. Prioritize companies that grow their dividends over time rather than just high starting yields. Who are the most reliable payers? The Dividend Aristocrats. S&P 500 companies that have raised their dividend every single year for at least 25 years. Some have done so for over 50. They have survived recessions, inflation spikes, pandemics, everything. Classic examples include Coca-Cola, Procter & Gamble, and Johnson & Johnson. Don't want to research individual stocks? Consider a dividend-focused ETF or index fund like SCHD, VYM, or NOBL. One simple purchase gives you exposure to hundreds of these steady payers. It's instant diversification and the snowball effect, without the homework. One last thing that trips up new investors. Right before the dividend pays, the stock price often ticks up slightly as people buy in to capture the payout. But right after payment, the price usually drops by approximately the dividend amount because the company just handed out cash. Think of it like a wallet with $100 inside. If you take $5 out of the wallet and put it in your pocket, the wallet is now worth $95, but you still have $100 in total. You now have the cash plus the same number of shares. Your total return is the combination of dividends received plus any long-term price growth. Panic sellers dump on the dip. Smart holders just smile. Free money arrived. Keep owning. So that is how dividends work. Companies sharing their profits so you can get paid just for owning their stocks. It is straightforward, tax-smart for long-term holders, and one of the cleanest ways to build passive income over time. The goal? Grow a portfolio that eventually generates enough dividends to cover your monthly expenses. Want $4,000 a month passively? At a conservative 4% yield, that's roughly $1.2 million invested. Reinvest consistently, add over time, and let compounding do the work. You'll reach it faster than most realize. This is not get rich quick. It's the tortoise approach. Boring, consistent, and it wins long term. Quick disclaimer, I'm a creator, not a financial advisor. This is for educational purposes only. Always do your own research and consider professional advice before investing your hard-earned money. If this helped you understand dividends, drop a like and subscribe for more clear investing breakdowns. Comment below, what is your first dividend goal? Thanks for watching. Go start building that money tree. See you next time.